ETFs can definitely be the key to a very prosperous financial future, but you have to ensure you understand what you are investing in and you are selecting the right ETFs for you. I am your Tater Tutor, and today I'm going to cover everything you need to know about ETFs, how they work, why they're perfect for the vast majority of investors, and how they can set you up for long-term success. At the end of this video, I'll show you how you can easily build and manage any robo-advisor portfolio and save on all of the fees, thus saving a huge amount of money over the long term. Let's go. ETF stands for Exchange Traded Fund, and it's a type of investment that holds a collection of assets like stocks, bonds, or both, all in one fund. So you get access to hundreds or even thousands of different securities, stocks, bonds, or both, in one holding with one purchase at a low cost. So some key highlights for ETFs: they do provide diversification as they have so many holdings that it really helps to reduce risk as it spreads it out across all of the individual securities that are in the ETF. Liquidity is another advantage to ETFs. They are traded on exchanges, so you can buy and sell them throughout the trading day, just like individual stocks. That makes them highly liquid and thus easy to access for us investors. They also typically have very low cost, especially when we are talking about market cap weighted equity index ETFs, which is a nice lead into the next topic. The ETFs that are used for the classic index investors track an index like the S&P 500 in the US or the S&P/TSX in Canada. So these are market capitalization weighted or market cap weighted indexes and ETFs. So the companies in these indexes, the stocks in the indexes, are weighted according to the size of each individual company or the market capitalization of those companies. So, market cap weighted equity index ETFs track broad-based equity indexes. The equities are weighted according to market capitalization, which means larger companies take up a larger proportion of the index and thus the ETF. As ETFs have gained popularity, other types have started to emerge. One very useful type for index investors are bond ETFs, but there are many other types, and they should not be confused with classic index investing options. Three examples are sector, smart beta, and thematic ETFs. So sector ETFs focus on a specific sector, like technology, healthcare, or energy. So it's a much less diversified ETF for investors, so it exposes them to a lot more risk. Smart beta ETFs use alternative construction methods other than market capitalization. So they try and achieve a higher return with a lower risk based on factors like momentum, value, quality, or low volatility. Thematic ETFs obviously focus on a specific theme. So a couple of examples are clean energy or artificial intelligence. They are a lot more speculative and maybe exciting, but a lot more risky and even less diversified oftentimes than the sector ETFs. So in summary, not all ETFs are created equal. Some don't track indexes at all and have completely different methodologies than market cap weighted equity index ETFs, aka standard, aka classic index funds, which are almost always significantly cheaper. My recommendation, and the same recommendation shared by many classic index investing gurus, is to not stray from the classic index ETFs and venture into some of these alternative types, and this is why. One of the reasons is rooted in the discipline that is required for index investing. Once investors begin to stray from the core principle of broad market exposure, they can begin to stray even more and more. They may find themselves tempted to chase recent hot trends or sectors. This can easily lead to more frequent trading, thus increasing costs and undermining the cost effectiveness of index investing. Over time, the compounding effect of these costs can really have a detrimental effect on our portfolios. Furthermore, by chasing the latest market winners, investors are effectively buying high and probably selling low. For instance, they may find a sector or a theme that's been really hot lately, so they dump whatever other alternative type of ETF they were with because that has been underperforming, and they go with what has been overperforming, thus they are buying high and selling low. In the long run, this reactive approach really undermines the core principles of long-term disciplined investing, and it often leads to costly mistakes that can really hurt investors' portfolios. Staying true to classic index investing principles really helps to avoid a lot of these pitfalls and keeps investors on track for consistent, long-term, reliable growth. So just a couple of more sections, and then we will get to our system, which helps investors easily build robo-advisor portfolios without the fees, thus saving a huge amount of money over the long term. Let's go. Before investing in any ETF, it's important to understand the key metrics behind the ETF to assess whether it is right for you and your portfolio. So one really great resource to do this is the fact sheet for the ETF. So you can oftentimes find the fact sheet really easily if you just Google the ticker symbol of the ETF and then just put fact sheet right after that. Now, you want to make sure that you are getting the fact sheet from the resource, so from the ETF provider, whether it's Vanguard, iShares, GlobalX, or whoever the provider is. Make sure it is their website. We're looking at the fact sheet for XIC. This is from iShares, their core S&P/TSX capped composite index ETF. Now, this is a market cap weighted equity index ETF. However, it says capped, which in this case means that no one holding or stock can take up more than 10% of this index. So we'll come back to this section of page 1 momentarily, but I am going to scroll down to the top 10 holdings, and you can see Royal Bank of Canada takes up 6.58% of the ETF and, of course, the index, because the ETF tracks the index. Now, if this ever got to be more than 10%, then it would simply be capped at 10%. And a good example of this happening in the relatively recent past was Nortel, which actually took up around 1/3 of the entire Canadian stock market, so 33%. So in that case, that 33 would have been cut down to 10, and individuals wouldn't be overexposed to Nortel, which in the end turned out to not be such a great thing because that stock crashed. Scrolling back up because we were not done with page 1, the key benefits is always important to have a look at. Obviously a quick read, and in this case, owning XIC means you own the entire Canadian stock market. Over to the right, key facts, the benchmark, as I already mentioned, the S&P/TSX capped composite index. It's traded on the Toronto Stock Exchange. Distribution frequencies, so this means how often they pay out dividends, in this case quarterly. Eligible for registered plans like your RRSP, TFSA, etc. Program eligibility DRIP, that stands for Dividend Reinvestment Plan. So if you do sign up for this, then they would not pay out dividends, you would just get additional shares every quarter. Units outstanding, this is the number of shares that are out there in the ether, owned or ready to be traded or maybe purchased by you. Assets under management, over 13 billion. So there's a lot of money in this fund. Number of holdings, 227. So owning this ETF means you would own 227 stocks. So one holding, but very well diversified. We'll scroll down a little bit and look at the fees and charges section. The cost you are going to be most interested in is the MER, which stands for Management Expense Ratio. It is a measure of the total annual cost for managing and operating an investment fund, and it is subtracted from the fund's returns. So you wouldn't actually see this money being deducted from your account. The MER in this case is 0.06%, which is very competitive and among the lowest for ETFs in this category. We looked at the top 10 holdings briefly, so you will see a lot of financial and energy in the top 10 holdings, and we will get into that again momentarily. Over to the left, you can see annual performance, the fund versus the benchmark. So the difference in these numbers is called the tracking error, and we want to see a really low tracking error because that means the ETF is tracking the index very closely, which is what we want and the sign of a good ETF. Scrolling down to page 2, we can get a look at some portfolio characteristics. I wouldn't pay too much attention to these. Distribution yield might be important to you. It's what you can expect to be paid out per year in the form of dividends. So for every $100 of this ETF that you own, you would be paid out $2.89 per year. And that's if the current distribution yield holds up. You can see right below that trailing 12-month yield is a little bit lower, 2.66%. So of course the distribution yield, the amount of dividends you get paid from an ETF, can certainly vary over time. To the right, the sector exposure, as I mentioned before, heavily weighted towards financials. That is Canada, folks, and then energy, and then you can see industrials, materials, information technology, and so on. Okay, we're going to go over currency hedging, and then we will get to our system that helps investors easily build and manage their robo-advisor portfolios on their own, saving on all of the fees, resulting in huge portfolio improvements over the long term. We'll get to that momentarily, but first, just wanted to explain currency hedging. So this is a method investors use to protect themselves from foreign currency fluctuations. So when investing outside of Canada, we are exposed to the currency of the country or the countries that we are investing in. So in the case of an ETF from the US, if we purchase a non-hedged version and the Canadian dollar goes up relative to the US dollar, then the value of our investment will go down. Conversely, if the Canadian dollar drops in value compared to the US dollar, the value of our investment will go up. Now, if we purchase a hedged version of that ETF and the Canadian dollar drops relative to the US, the value is not affected. And the same can be said if the value of the Canadian dollar increases compared to the US dollar. So it's typically done when investors purchase bond ETFs from outside of Canada. This is because the bond or fixed income portion of our portfolio is supposed to be the safer section of our investment and shouldn't be too volatile. So if we were exposed to foreign currency fluctuations in that portion of our portfolio, it would certainly become more volatile and less reliable. It is commonly recommended to not purchase hedged versions of developed markets ETFs. One reason is cost. Hedged versions of ETFs are almost always significantly more expensive than their unhedged counterparts. And it is also often helpful to have exposure to developed markets currencies. In the case of market dips or crashes, investors oftentimes will purchase more of the US dollar, more of the Swiss franc. Thus, you get some benefit from that foreign currency exposure as well. It's a good diversifier as long as you don't have too much. So at this point, I should mention home country bias. Canada only takes up 2.7% of the entire global equity market, but many Canadians invest a significantly larger portion of their portfolio in Canadian equities. I typically recommend investing about 1/3 of the equity portion of your portfolio in Canadian equities. This is based on the data I have seen. When you get much less than 1/3 Canadian equities, it just opens you up to more foreign currency fluctuation. So some is a good thing for the portfolio, but too much can just give your portfolio too much volatility. It is time to find out how you can get access to zero-fee robo-advisor portfolios. Really quick, just want to show the amount of money investors could save simply by using our program and eliminating the fees charged by robo-advisors. It is really remarkable. As you can see across the top, this is the initial investment amount, and then along the side, the investment horizon is the number of years invested. So over 20 and 30 years, you can see the different amounts investors could expect to save simply by eliminating the fees from RBC. So as you can see here, even if you only have $50,000 to start, after 30 years, you could expect a portfolio improvement of over $126,000 just by eliminating these fees. Let's hop over to our Tater Portfolio Manager, and we will really quickly show you how to easily build and manage one of these portfolios to save on all of the fees, and we will open up the RBC Growth Portfolio. But as you can see, we've loaded in all of these portfolios from Wealthsimple, Modern Advisor, Questrade, CI Direct, and RBC, so you can build any of these portfolios on your own using our spreadsheet here. We'll click on the tab here to open up the RBC Growth Portfolio, and all you have to do is enter the initial amount you have to invest. So let's say 50,000. And then you simply purchase the number of shares shown in the shares to buy column. And when you do that, you fill in the table below after you purchase the shares from your brokerage, which we are happy to help with as well. And then you can see the remaining uninvested cash is just over the 2% called out for in this portfolio. In the future, when you have additional cash to invest, you would enter it into this cell. For this example, let's say we have $5,000. We'll just enter that, and then the far right column will show you the number of shares you need to buy in this situation. And then this column also shows you the number of shares to buy or sell to bring your portfolio back into balance in the future when share prices fluctuate. And as mentioned before, investors really only need to rebalance one time per year, so very little time is involved in managing these portfolios, and this time is very valuable. It can be worth thousands of dollars per hour just based on the long-term savings. Our Tater Portfolio Manager spreadsheet is free for a limited time for our YouTube subscribers, so let us know if you are interested. We also provide instructional videos and help along the way via email. Before you do anything else, make sure you hit that subscribe button and ring the bell so you don't miss out on our next video. If you want that spreadsheet we showed to help you build one of the robo-advisor portfolios on your own to save on all of the fees, let us know. Leave us a comment, and we'll see you again soon.